On today's episode, how's Disney restructuring? Is it getting ready to sell ESPN? Would it actually sell Hulu? And it looks like investors will be seeing a dividend this year. Okay, so a lot has been going on with Disney over the past day. It beat analyst earnings estimates, and it announced that it's going to reorganize into 3 divisions. Disney Entertainment, which will include most of its streaming and media operations, ESPN, which is going to include the TV network and ESPN Plus, and Parks, which will be its experiences and products unit. On its earnings call, it also said that it would be cutting $5.5 billion in costs, which will be made up of $3 billion from content, excluding sports, and the remaining $2.5 billion will come from non-content cuts. Disney executives mentioned that $1 billion in cost cutting was already underway. Disney also announced that it would be eliminating 7,000 jobs, which is roughly 3% of the 220,000 people that it employs. These moves mark the most dramatic since Bob Iger took back the reins from his handpicked successor, Bob Chapek. The entertainment group will be led by top lieutenants Dana Walden and Alan Bergman, who are each considered top contenders to take over for Iger when he leaves. ESPN chairman Jimmy Pitaro will lead the ESPN segment, and Josh D'Amaro, who's already head of Disney's Parks, Experiences, and Products segment, will remain in control of that unit. The future of ESPN under Disney has been a question for some time for investors. Last year, Third Point, which is led by activist investor Dan Loeb, urged the company to spin out ESPN. Disney and Third Point later reached a deal after reversing course on its thoughts for the future of ESPN. Iger addressed speculation that the company may look to spin out ESPN due to the network being put into its own division. He noted that while ESPN has been struggling due to cord cutting, the brand and programming remains in demand. On Disney's earnings call, Iger said, "We're not engaged in any conversations or considering a spin-off." He said that the move was considered in his absence, and it was concluded that it was not the right move for Disney. Iger did note that he and Pitaro would be more selective on what it spends on sports rights. ESPN Plus had 24.9 million paid subscribers at the end of last year, which is up 2% from the year before. While Iger is not interested in selling ESPN, he may be interested in selling Hulu. Currently, Disney is the majority of Hulu, with Comcast owning the other third. Under a put-call agreement, Comcast can require Disney to buy its stake, and Disney can require Comcast to sell the stake starting in January of next year. Hulu's fair market value will be assessed by independent experts, but Disney has guaranteed a sale price for Comcast that represents a minimum total equity value of $27.5 billion. When asked about his plans for Hulu, Iger said that everything is on the table right now, so I'm not going to speculate whether we are a buyer or a seller of it. When he was asked if he'd be interested in selling Disney's stake to Comcast, he said, quote, "We will be open-minded." Activist investor Nelson Peltz has come out and said that he's ending his proxy fight against Disney after Iger announced his cost-cutting and restructuring plans. Peltz had amassed a stake of about $1 billion worth of stock and was seeking a seat on Disney's board at the annual meeting in April. He was lobbying investors heavily and had even set up a dedicated website called Restore the Magic, where he detailed what he thought the company's failings were. But Peltz said that Iger's recent restructuring plans, as well as the most recent quarter earnings and the instatement of a dividend, have addressed most of his concerns. Speaking of its dividend, Disney will reinstate its dividend by the year end. The payouts were stopped abruptly during COVID to conserve cash. Iger has said, "Our cost-cutting initiatives will make this possible, and while initially it will be a modest dividend, we hope to build upon it over time." To me, this is kind of odd, since they cut the dividend to save cash, and now they need to save cash again, but they're using some of that saved cash to pay out a dividend, but I'm not the CEO. It seems like this is a move just to appease some shareholders. Wall Street loved the recent earnings and the restructuring plan. Many Wall Street analysts have already adjusted their price target for Disney. Bank of America's Jessica Reif Ehrlich reiterated her buy rating with the target of $135 per share, and Wells Fargo analyst Stephen Cahall raised his price to $141 a share. So what's the future going to look like for Disney? Well, Iger said that it's going to focus on its own franchise IP. It already has Toy Story and Frozen sequels in the works, 2 major hits for the company. Iger reiterated that streaming is the future for Disney, and that might bring some short-term pain. He noted that they need to take a look at the unit, including a closer look at its pricing structure and its promotions. He said, quote, "We are in the global arms race for subscribers."